My name is Maria Thacker-Gothi. I'm President and CEO of Georgia Bio, and we're excited for our next session of the 2021 Georgia Bio Innovation Summit. We are in our 20th year, and we're already off to a great start. I will say that next year we do hope and do plan to have this conference in person again. So though we have enjoyed doing this via Zoom, I know many of us are excited to see each other in a safe way in person, and we are looking to 2022 to start opening up and begin hosting some in-person events in the next year. But we do appreciate you joining us virtually this year. And yesterday, I mentioned this morning, we had a great scientific poster session with our young people from across our university system. I encourage people to go and watch those videos, and we look forward to announcing the winners next week on Thursday. And this morning, we opened up with a really dynamic conversation between the CDC director, Dr. Walensky, and Emory's new president, President Fenves, followed by a really powerful message from our Diversity, Equity, and Inclusion Task Force and our newest team member, Edie Stringfellow. So again, all of these recordings are available in our system on Jublia. I encourage you to go back and view it. There's still time to encourage others to register and have access to these viewings. So if you have any questions or anything, just reach out to our team. Finally, I would also like to say that thank you to all of our sponsors and exhibitors and speakers. We still have a great program ahead of us today, and of course next Thursday on October 21st, please join us for our rapid fire research and company showcase presentations. And it's our innovation day, and during this day we will also talk to you about some of our workforce development initiatives. We will be launching our brand new career center, and we're very excited to also launch our Bioinnovation Mentoring Lab program. So this is an exciting time for the organization as we close out 2021. We're very excited to dive into our next session for Summit. And before I pass it over to Steve Damon, our moderator and fearless board member, I'm very excited for this panel. It's extremely timely. It's very appropriate for our market and our companies. The evolving landscape of funding changes every year, but in the last year and a half, it's changed even more so, and we're excited to have a variety and a very robust set of speakers today to dive into these questions. I will say we will be taking questions at the end of this particular session, so do put them into the chat box. And with that, I'll hand it over to Steve Damon. So thank you, sir. Steve.
Thank you, Maria. Thank you. Good morning to everyone. Welcome to our panel discussion on navigating the funding landscape. I'm Steve Damon, not Maria Thacker, and I'm the CEO of Micron Biomedical. Micron is a private company formed around a dissolvable microarray technology that was initially developed in the Georgia Tech labs of Dr. Mark Prausnitz. Micron has a technology that is particularly applicable to today's times. We have a technology for drug delivery that is a self-administration or low-skilled caregiver administration technology for vaccines and therapeutics, some very potential positive benefit in the future, especially around pandemics. So Micron's currently in the later stages of our first ever equity round of financing, our Series A targeting about $20 million. So having done that for the last number of months, frankly, the subject matter for today is near and dear to my heart, and I'm looking forward to the discussions. So for today's panel discussion, we are joined by three outstanding young executives who each have a specific and related expertise that I hope you will find informative and helpful today. I would like to be honored to introduce those panel members briefly. Megan Blewett is a recent ex-Venrock investor and currently an entrepreneur in life sciences startups. And she'll talk a little bit about that and her experiences. Gaston Berthet is a vice president of life sciences commercial banking with JP Morgan. And David Jett is a Vice President Investment Banking for JP Morgan. And so what we plan to do this morning is the panel will each briefly introduce themselves and their experience, as well as provide you some related information. We do have some slides to present. And then at the end of the panel discussion and presentation, we will open up for questions and answers. So that said, I'll start with Megan. If I could start with you and we could get the slides put up, we'll be ready to go.
Yeah, thanks so much, Steve. I'm really excited to be here at the summit and to get this chance to interact with you and Gaston and David, and also to hear any questions that people might have about launching and fundraising early stage biotech companies. So to the audience, as Steve mentioned, I am a co-founder and president at a seed stage therapeutics company that is venture backed. And prior to joining this company, I was an investor at Venrock. So the company that I'm currently at, Iris Medicine, was incubated within Venrock, and Venrock is an investor in Iris. So there's still that tie to the venture community, and I'm happy to talk more about that process today. So next slide, Ashley. So one thing I want to emphasize today is that many great biotech companies have academic roots and come from academic science. And I think this is important to emphasize because, quite frankly, when I was nearing the end of my PhD, it felt kind of overwhelming thinking about starting a company and securing capital. But I want to emphasize that this is a path with some real precedent. So next slide. I'll quickly talk about a few different examples. One is a company called Anacor that was in the Venrock portfolio company prior to being acquired. And Anacor is based on academic science from Lucy Shapiro's lab at Stanford and Stephen Benkovich's lab at Penn State. They developed some quite innovative boron chemistry technology that ended up being foundational for the development of new medicines. Next slide. Another well-known example is David Walt at Tufts. He developed what's called bead array technology, and that ended up being extremely important for the foundation of Illumina, which today, as many of you know, is the dominant player in DNA sequencing. And another great example of academic science leading to the development of new medicines is the foundation of Genentech. UCSF scientist Herb Boyer had developed, along with other people in his group, recombinant DNA technology. And I think we can all appreciate now how important that has been. So I think as a society, it's critical that we have mechanisms for taking this exciting new science and building companies to translate that science. But the question is, how do you actually go about securing the capital to start a company? There's so many pieces that have to come together. It can be rather daunting. So next slide. What I would say is before you actually go out and raise money, you should first ask yourself, is it a good time for the company and for the team to actually raise money at this point? And a few questions to ask are, have you exhausted what you can do within academia? And this is very important because if there are other experiments that you can do that would meaningfully increase conviction in your platform, that would potentially allow you to raise at a higher pre-money valuation when you do approach investors. So just because someone says, I can provide you some funding for your company, doesn't necessarily mean that you should take it. You should think long and hard about whether you can actually increase the valuation further through other work or experiments within academia. Another thing to think about is, do you have line of sight to a meaningful value inflection? Meaningful being something that investors would care about or would give you credit for. So a common preclinical value inflection point would be in vivo efficacy for a therapeutics company. When might you be able to achieve that? Things you should have when approaching VCs: compelling technology, path to defensibility. That one is very important. VCs will want to know, what is your moat? If you do something great, how do you protect that? And third is some sort of large addressable market that you could potentially pursue with your technology. Importantly, things you don't need before approaching VCs include a fully formed team. I think this is something of a misconception in the industry. It's much better to have no team than to have a bad team, and VCs should ideally help you build out that team. That should be one of their core competencies. Also importantly, you don't need a legal backend. You don't even need to have set up your legal entity or have corporate counsel, that sort of thing. That's another area where VCs should be able to help you. Okay, next slide. So taking a step back, what are the possible types of funding that you might want to consider for your new co? One would be traditional debt financing. And the advantage of this approach is that there are many potential sources of capital. The downside is you could be looking at higher interest rates than other sources of financing. One of those would be a convertible note, which also is a form of debt financing. What people like about convertible notes is that you don't need to set the valuation at the time of the raise. And there are many founders in particular who like that flexibility. The third type of funding, and that's the one that I'm most familiar with, is equity investment from people like VCs. And VCs will tell you that this creates better aligned incentives between founders and investors if everyone is getting some defined piece of the pie or some defined amount of equity. The downside is that VCs do have specific criteria that they look for. And if you are trying to build a company that doesn't meet those criteria, VC financing might not be the best path forward for your company. Okay, this segues into types of investors. So one possibility, one path that is available to companies is simple bootstrapping. If you can potentially get to some value inflection milestones on your own capital, then there are plenty of people who do that and they maintain quite high ownership. The risk there is, companies are already very risky, and putting in your own money adds to that risk. And potentially you have access to a much smaller pool of capital. Another route is angel investors. And actually yesterday in a practice run of this, Gaston mentioned incubators, and I would put incubators in a somewhat similar category to angel investors, and they're a very important part of the ecosystem. So with angel investors and incubators, you can potentially raise capital very quickly. The downside is that those investors may not be able to provide follow-on funding for a Series A or Series B round, and you want to make sure that you get investors that have expertise in your area and will be able to help guide the company. The third category is institutional investors, or VCs. So one of the reasons why people might want to work with a VC is the VC will probably have access to larger amounts of capital and ideally would have expertise in the company's area. And the last category is strategic investors. This might be, for instance, a large pharma company that wants to learn more about or have a foot in the door for some interesting technology. And the nice thing about strategic investors is that you could potentially access non-dilutive capital and large amounts of it. One of the downsides to be cognizant of, this isn't necessarily true, but it can be the case that if one large pharma invests in your company, it can make it more difficult for your company to be acquired by other large pharma companies. So something to consider. So to recap, the funding climate now is very frothy, and in biotech in particular, there's a lot of capital moving around. In these climates in particular, it's very important to remember that it's not what can you do. For instance, if someone offers you money, it's not, I can get money from that person. It's what should you do for your company? When should you actually spin out from academia, and who should you raise that capital from? All right, and that's all that I have. I will hand it over to you, Gaston.
Thanks, Megan, and thanks, Georgia Bio and Steve, for inviting me on this panel, and thank you to the audience. My name is Gaston Berthet. I am a vice president banker on JP Morgan's commercial life sciences platform, as Steve mentioned. What that means quickly here is that me and all the bankers on this platform are dedicated to life sciences. For JP Morgan, that's biopharma, biotech, medical devices, tools and diagnostics, CROs, CDMOs, and really succinctly anything that's going to touch the FDA. So we spend all of our time counseling companies, doing transactions for companies, and working on the day-to-day banking for companies that are in those spaces. And you can advance the slides, please. Our commercial platform, again, day-to-day banking, a full range of financial solutions, and for companies in the very early stages, which I think is usually something that prospects of the bank don't know, we're working with companies as early as the inception of the business, and we are waiving fees in those early stages. So please, talk to me, reach out to me on the Georgia Bio platform. I think my contact information will be in the deck. Reach out. We're expanding in the Southeast. We're invested in the success of the region. And so we'd love to talk to you. And so on this slide, I'm not going to reference it heavily, but to kind of break up the life cycle into 3 stages, sort of early stage, expansive stage, and later stage. You see here some of the solutions that we commonly offer to our clients in those stages. And as it pertains to the conversation today, sort of early stage, let's call that sort of before Series A, so seed and earlier. We're working with companies, again, at inception, we're working with companies that have billion-dollar market caps, that have gone public and that are accessing capital markets for follow-ons. And so with that sort of broad spectrum, right, we're seeing all different types of capital providers, all different kinds of capital structures and strategies. What's common for us when a company is coming to us very, very early, as Megan kind of alluded to, right, they're passing around the founders and the doctors and the early stage leadership, passing around the hat to sort of friends and families, tapping into their personal network. Maybe there are high net worth individuals that they know of, kind of doing all of those very resourceful things to get capital into the company, to get the platform technology kind of off the ground and headed towards a proof of concept. In this stage, sort of valuation, dilution, these kinds of considerations are not really on the table, right? You're just doing what you can do to get the capital into the company. We also see, grants, right? NIH, Department of Defense, and all the sort of government agencies. I think there are a lot of them, maybe 20 or 30 agencies. And so accessing those funds is very helpful, I think, in the early stages. Nonprofits, right, that maybe specialize in research in your subsector and indication areas are also useful sources of capital. But as you sort of start proving out the concept, developing the platform technology, and your trajectory comes a little more clear, and you start thinking about sort of seed investment. Again, I think 2 sources of capital that are important are the incubator and the angel. Megan alluded to these. All right, I'm going to go into them just a little further. So, the incubators are very, very helpful, right? Typically, they are also invested in the success of the region, in the success of entrepreneurship in the region, and business growth and economic growth. And so they're invested, and they're investing in you. And so they're a nice source of capital, but they also bring a range of other resources, whether that be networks and mentorship and lab space and office space, and all of these things, right, which is why they're also referred to as accelerators, really accelerate the growth in the early stage in a way that I don't believe that you could do, or it would be very difficult to do on your own. And so, in Georgia, we have ATDC on the medical device side predominantly. They're a great incubator, right, for example, that are, they're preparing companies. And as we see companies transition out of ATDC, right, they are prepared for commercialization, right? And so, a lot of value add from a partner like that. And that's exactly what you want from a partner, even VC, as you get further down the road. So I'm a big fan of incubators and accelerators. I think angels, which are typically high net worth individuals who are coming in to put in money when you're very, very risky, right? Very, very early stage. They're willing to take that risk, but as Megan mentioned, they may not stay invested, and it's less likely that they're going to bring a variety of other resources that kind of help you grow and scale. Convertible debt, right? That's traditionally how angel investors are investing. So they become debt holders, and they're going to take an equity position at a discount, right? Likely as you head towards towards the Series A. Megan brought up a good point, which is deferring your valuation, right? I think if you can, the longer you can defer the valuation, the better. There's a couple of reasons. One, it's cheaper and more timely to access the capital if you don't go for the valuation. And two, if you go for the valuation too early, you as the founder, your perspective is likely going to be, you don't like the valuation, or it's not as high as you thought it should be, because you see all this kind of unlocked value in the company, right? So if you can unlock some of that value, defer, right, the valuation maybe to the Series A, right? Then when the convertible debt holder takes an equity position, it's less dilutive. It's less dilutive for you. Won't go through the math there, but trust me, that it's less dilutive. Incubators, angel investors, great sources of capital, but the preponderance of capital flowing into life sciences is from VC investors, right? I think it's something like 70% of all funding is coming in from VC. So this is very important, right? Series A is when you're going to really start to think about VCs. It's really important to get the right investors behind you if you can at the Series A, because capital attracts capital. And if you can get the right people in, they're kicking the tires on the company, they're signaling to the investors, the rest of the investors out there in the universe, right, that there's some validity here. And hopefully you can find someone who stays invested. And remember, like, a VC is going to be able to buy into the additional equity rounds at a discount. And so, you want to get them in, keep them in, and that just makes the future equity raises that much easier. So a couple of things here, and then I'll pass it to David, right? I think, when you're thinking about VCs and the way that they're looking at you and valuing the company sort of in the early stages, so Series A, right, they're less focused on the business model, less focused on cash flows, right? Because that stuff is still far out, and it's very hard to value a company from that kind of commercial aspect, right? There's still reimbursement considerations from private payers. There's Medicare, there's Medicaid implications. You may do something strategic before you're even commercial. There may be, royalties or licensing agreements, et cetera, that impact cash flow. So the sort of cash flow valuations will come later, especially if you're looking at a sell side mandate or tapping the public markets. But in this stage, the valuation is more, what's the likelihood of probability? What's the probability that this is going to, make it through the regulatory process, right? So probability of success, likelihood of approval, right? These are very, very important. And what you're doing as a company is you're taking something very, very risky, a very, very risky investment, and you're de-risking it every time you hit a meaningful milestone, right? And so every time you hit those meaningful milestones, there's a little less risk, there's higher probability that you'll be successful, and it helps you attract more VCs that are going to take, less risk. But in the early stage, you can get someone in, they like to take the risk, because if you're successful, you can return the whole fund, right, to the VC. You could return the whole fund, right? And so there are plenty of people out there looking for those moonshots. But remember, it's a risky landscape. I think at any given moment, 90% of life sciences companies are actually not generating revenue. So it's a very small percentage of companies that make it all the way through and have commercial success. So one takeaway, and then I'll pass it over to David, is, when you're thinking about marketing yourself to investors who are going to come in early and take that risk, what's very important, I think, is for you to have a well thought of plan, a roadmap. And the best ones that I've seen are, it's a product roadmap, so sort of visually left to right, a timeline of product development milestones, regulatory milestones, right, commercial milestones. And then what you want to do is tie in capital, a capital formation plan. So this is how much money I think it's going to take me to get to this milestone. At that point, I've exhausted my cash. I'm going to need to raise more cash, right? And if you can lay out your plan sort of left to right, It communicates, I think, a lot to investors. It's a great starting point for dialogue. It says that you understand cash burn, you understand cash runway, you understand the roadmap to de-risking. And again, it's just it speaks very highly of leadership if you can come in prepared to speak like that. There are a couple of other types of financing. We'll get them into them today for the sake of time. But quickly, there's corporate VC, and they're getting in, I think, earlier and earlier, seeing them go in at seed rounds and Series A's for a variety of strategic reasons. But a corporate, right, and this is J&J, Pfizer, AbbVie, I mean, all of them, right? They'll get in early if they see some strategic value in what you're doing. And what they're, again, doing is helping you de-risk efficiently, right? So they're lending product expertise, regulatory process approval expertise, and helping you avoid missteps along those roadmaps that can be costly, right? And they can extend the time and extend the capital that you need to get to commercial success. There are strategic partnerships, right, with these same types of companies that can lay the groundwork for a strategic acquisition, right? Non-dilutive, strategic, very validating to the platform. There are licensing agreements, and then sort of finally there's venture debt, which we do offer at JP Morgan. And you could advance the slide, please. And so here what you're seeing is sort of our version of a visual representation, sort of swim lane, right, of what we offer through different lines of business at the bank and through different milestones of the company. But so venture debt is something that we do offer. We're selective with it. And again, it's going to rely on the quality of your investor base to access venture debt from JP Morgan. But we're having these kinds of conversations all the time with companies, with prospects, with clients. And when there's enough momentum, enough inertia, and when the timing is right, we'll introduce our clients to our investment bank partners, right, who can then come in and drive more strategic dialogue around sell-side advisory and sort of IPOs and capital markets particularly. And so that's when I would partner with someone like David. And so David, I'll pass it to you.
Yeah, thanks so much, Gaston, and thanks to all the attendees today. We're all very grateful to be here, and we hope you find the presentation helpful. I think Gaston alluded to it. I'm one of his partners on the investment banking side. Both he and I sit here in Atlanta, so we were really thankful that Steve reached out to us to present today. We wanted to make sure that people knew we're here in the market. We're happy to be helpful. Would love to answer questions after this. And what I'm going to plan to do is go through my pages fairly quickly, because I think the Q&A, is going to be hopefully a helpful part of the session. The way I started the framework here for my pages is really quickly touching on markets, right? Where are we today? Brief market update. Then I wanted to jump into how an advisor like JP Morgan could help someone thinking about a liquidity event, because ultimately when you start a business, right, at some point you're going to either have to exit the business or pass it down to the next person in line in your family or whatever the next exit plan is. So once you reach a certain level of maturity, you would reach out to us and we would hopefully help with that. So let's move to the next page here in the deck. It's a brief equity overview that shows how the markets have performed on a year-to-date basis. If we can move to the next slide, that would be great. A handful of themes here, I think, and overall what you can see is the performance has generally been above where we started. And this page actually is a little bit outdated, being around 2 weeks old. It's sort of from the start of October. We've actually flipped back and things are continuing to move in the upward direction today. A few themes, right, that are driving where markets have been heading. I think on the positive side, right, there's been continued low interest rates. That's certainly driven investors to move into equity because yields on other investments aren't quite as high, right? There's always been this continual search for growth. That's been a theme for a handful of years. People are looking at companies doing M&A, looking at companies innovating and inventing new things. I think in the pharma world especially, and thinking back to COVID, right, it's been a really hot sector where there's been a tremendous level of activity, and I think that people are looking forward to the next handful of months, next 6 to 12 months, and saying, look, we continue to expect the reopening theme to be prevalent, and we expect that with that, companies and businesses and consumers are going to continue to do very well, and that there's going to be a lot of spending that's out there. And so all of those factors, I think, continue to contribute to an upward trajectory. On the flip side of that, if you're someone with more of a bearish mindset, you certainly could be concerned around inflation trends. You could be concerned around the supply chain issues that we've seen that are prevalent in the news. And I think also, the Delta variant is still out there, and that's causing a little bit of noise. But overall, it feels like things continue to swing in the positive direction. I actually saw this morning that for the first time since March 2020, initial jobless claims came in at under 300,000. So that was definitely a great boost to the markets, and I think things are generally trending up today. We can flip to the next page. I'll talk quickly about the M&A market, or actually, this is before the M&A market. We're talking more about the IPO market for biotech. On the left side of the page here, you can see volumes have been up, and I think are very healthy. I think 2020 was a great year for biopharma. With the pandemic, I think it was arguably the hottest sector for investors to put money into. And you can see that, on the left side, the dollar volume and deal volume was quite high, and we've essentially gotten back to the same level on a year-to-date basis in 2021. But on the right side of the page, what's really interesting is in 2020, there were actually no biopharma IPOs that priced below the range. So that just shows the strength of the market. And if you look to the right half of that chart, you can see that trend largely continued right through Q1 of 2021. There were, again, no deals that were below the range. As you move into Q2 and then into Q3, we've started to see a handful that have priced below the range. And I think that, the big driver there has really been, these things tend to come in waves, right? And so the front end of the wave, a lot of people have gotten into a lot of newly IPO'd companies, and therefore, as time moves on, right, they're more selective around what opportunities they pursue. The market is also just very crowded overall, not just in biopharma, but in other industries too. And so there's certainly been, no drop in the supply of new issuances coming to market. And when that happens, right, that certainly can lead to pricing outcomes where you have certain businesses that end up falling below the range. So on the next page, I want to talk about the M&A market, because similar to the IPO market and the general equity market, this is also a market that has performed extremely well. 2020 was a little bit of an interesting year because for the first half, M&A activity essentially died, and nothing was getting done. People were really focused on putting cash on their balance sheets to avoid bankruptcies or any sort of operational issues that they might have encountered related to COVID. But as the second half of the year picked up and people felt confident with working from home situations, and there was federal stimulus, M&A discussions really resumed and picked up with full force. And I would say from the second half of 2020 all the way through where we sit today, the M&A market has really been on fire. What you can see on this chart on the far right that's really interesting is that on a year-to-date basis, we've actually surpassed prior all-time highs in North America. And without a question, 2021 is going to be the new all-time record for M&A volumes. So both markets are extremely active today. And I think, if you have a business that you're thinking about selling or taking public, a big consideration for you outside of just, where are we in the company's life cycle is what does the marketplace look like? And in today's market environment, it's certainly very positive, and it's a good time for people to consider, going public. If you flip to the next page, I wanted to include a little bit around, if you're going to hire an advisor, what are the benefits to hiring an advisor? Why would you hire an advisor? These are a handful of, themes that I think are really reasons why you would do it. So, starting on the left side of the page there, it really comes down to expertise in valuing a business, right? If you're going to take a company public or if you're going to sell a company, that's the critical question at the end of the day. What's the valuation here? What are my goals and objectives as a seller? Do I think that that's reasonable and achievable in this marketplace? And, from our side, we specialize in running valuations, day in and day out. So certainly that's something that we would help you think through on the front end is make sure that we feel like the marketplace is conducive to a liquidity event where you would achieve the outcome that you're hoping for. I think for the next, pillar here on the page, talking about managing the transaction process, if you're going to sell a company or if you're going to take a company public, it's a very defined timeline. It's a long timeline, but it's defined, and there are process steps that happen throughout. As your advisor, we would set up a timeline on the front end that achieves your transaction objectives. There's a specific, timing milestone by which you want to be public or by which you want to sell the company. We can help structure a process to help you do that. And, we can make a timeline as granular as a daily calendar, right? It can help you think through on each day, what are we doing to make sure that we can achieve the ultimate objective? The third pillar here is talking about independence being an insurance policy. It's just that we're a third party, right? So we come in, we can look at your business, we can help you diligence your business, we can get it ready and prepped for a phase of marketing. And because we, aren't tied to the business outside of the engagement that we're working on, and because we also work with a lot of other businesses in your sector, we can give you unbiased perspectives on, what are the real highlights for your business that we need to make sure other people recognize, investors or buyers, right? What are the things that we think they're going to look at and maybe have some concerns for, and how can we prepare on the front end to address those concerns? So that's a big thing that I think that we bring to the table that really helps processes go smoothly from start to finish. The next bit here about being a complement to the company's financial staff, we have expertise with building financial models. When you're marketing a company, that becomes really important. I know Gaston was referencing the timeline and milestones. Well, we like to translate that into numbers, right? If people are going to put an investment into your business, they want to have a sense for what's the ultimate return that they can achieve, and what does that look like. So in addition to having a timeline that shows those milestones, we would translate that into a financial plan that can help investors understand, where the business is today and what the potential is for it in the future. In addition to that, we're also going to help with marketing documents, because if you take a company public or if you sell a company, you have to be able to communicate the story and present data and metrics to highlight, what makes the business different, unique, well-positioned, and, poised for growth. I think at the end of the day, that's what gets folks excited when they're thinking about buying your business or investing, right, if it's an IPO. And then the final point here on the page is that we interact with, the investor base that we're targeting if it's an IPO, or the buyer group that we're going after if it's a sale process on a daily basis. And so these are people that we know really well. And I think we know not only what they're looking for the investments that they're trying to make, but we also know what their behavior is like in typical transaction processes. So I think it helps you, as the seller, understand, if someone's genuinely interested in what you're, selling. If maybe they're not so interested and they're just fishing for information, right? We typically know what to look for as it relates to kind of what's normal behavior for them. And I think it helps with negotiating the deal at the end of the day, right? We know what levers to pull, and we know how to make things interesting for them. We know how to look out for you and your best interests. So then if you flip to the next page, and this is the last one in my piece here, this is just a high level overview, for all of the various aspects of any process, right? I think if it's an IPO or if it's a sale process, each of these 6 factors is going to be important. I think on the top left, preparation is really critical. Let's make sure that we have all of our documents and any data that we have on our business nicely ordered so that we can present it to somebody. Whenever a buyer's doing diligence, before buying a company, they need to make sure they know what they're buying, right? So we would help on the front end organize all the data in a way that's easily digestible for the buyer universe. And we also would do that for an IPO. You don't really quite give away the same level of information, but certainly you would be, talking to investors about key points that they would be interested in learning about through the marketing process. So that usually takes a bit of time, right, to do the prep work. And you want to be organized on the front end to prevent any, hiccups, right, during the process. The next bullet here, marketing materials, just goes back to what I was saying earlier. If you're doing a sale process, you have to create a teaser, you have to create a SIM, you have to create a management presentation. Each of these are used in different ways. Teaser, puts the opportunity on someone's radar by, through an email, they get to understand what the opportunity is. A SIM is more of a written document that they can go through to evaluate the opportunity. Eventually, you would present the business through a management presentation, which is more of a format like today's discussion, where it's slide based and the management team can talk through the business. If it's an IPO, you'll have a roadshow where you do a similar thing where you present, sort of an overview of the business, and you have to write a big prospectus. We write these day in and day out, and make the process easy. And it is a lot of work, but it's something that we have real expertise in. I spoke earlier about process management, relationships with investors. Something I didn't touch on so much, but it's worth reinforcing here is market knowledge. Because we are in the market with a lot of transactions, not just in the healthcare space, but other industries. And that's both on the IPO side and the M&A side, right? We have really good insight into kind of the latest trends and the latest valuations and drivers of valuations across a variety of industries, which again is really critical as it relates to a liquidity event. Then I guess the final point on the page here, strategic and tactical advice. Processes are fluid, so we'll create a timeline on the front end, like I mentioned, but you have to be dynamic as you're going through it and react to various buyers in certain ways, so that you always want to be flexible, right? To make sure that when you're negotiating with another party, there's always a second party, right? That's also interested. We have expertise in maintaining competitive tension, ensuring that the process can fit to the dynamic, so that we can maintain interest from either buyers or investors from start to finish. So the thing I'll close with here before turning it back over to Steve and Q&A, I'm sure on your minds is, if I'm thinking about a sale or an IPO, what are some, markers that I should be pointing towards that would suggest I'm ready? A typical company, you would expect to have revenue and even EBITDA, which is profitability. But this is a unique space, right? And that's actually not a prerequisite in this space. But what I'll say is, and Gaston alluded to this earlier, I think that the backers that you have that are supporting your business is actually really important here. Like he said, people typically back people that they're comfortable with and familiar with. And in this world, if you have a good group of VCs who have gotten you from sort of the seed stage up to a more advanced stage, and then you have somebody who could be a crossover investor, which means someone who puts in a private round right before you go public, but effectively speaks to the fact that when you go public, they're going to help support the IPO. That's a huge marker, right? And I think if you're going public and you can have that dialogue with other investors and say, hey, a really large, well-known institutional investor is backing this company, and they just did a private round, and the expectation is that they're going to be a crossover investor for a public offering. That gives people a lot of comfort, right? And I think at the end of the day, it's all about highlighting to people why you're in a good position to be supported through the growth milestones that are up and coming. And I think speaking to that too, right, is as Gaston alluded to, having a good timeline highlights all the various milestones that you're going to hit. I think if you are going to go public, you want to make sure you have some noteworthy milestones that are coming up, probably within a 12-month window, right? So that if I'm an institutional equity investor, I say, hey, I can get into the story today, and I know that in 3 or 6 or 9 months, there's a milestone that's coming up. And if I feel good about the business and prospects, that's a little, that's a carrot out there for me to get excited about, right? And I think that's a big, can really, stimulate some interest on the institutional investor side. And, I think something that Megan alluded to earlier, and I think this is a really important thing too, is it the right time for your company to go? And how do you know if it's the right time for your company to go? And I think that, defining what the use of proceeds are, are you trying to use the proceeds to really invest in the growth of the business? And do you really need those proceeds? And do you need a big quantum of proceeds in order to do what you're trying to do? In my mind, that I would say, yes, maybe, a public market opportunity is right for you. Or do you need a strategic, private equity fund to come in and deploy some capital with you to help with that growth plan? At the end of the day, it sort of comes back to you and your business, and is, the question is now the right time. In some ways, it's really dependent on your objectives, and knowing what those are and what the milestones are and why you need to go public now is really important. And I think explaining that to people is also really important. And again, a huge, helpful part of the story, right? If they can understand why you're going public now, they can get behind it. So with that, I'll pause. And Steve, I think I'll turn it back over to you for a Q&A.
Thanks, David. We can go back. There you go. Hey, look, the fact is I have a number of questions here, and we are running out of time, but I I want to just, in fact, the overview is so fantastic, at least that's how I feel about it, from navigating the funding landscape, basically from seed and on. I think your presentations were outstanding. We just don't have time to get into the questions because it would take a long time to do something better than what we've just presented. So I'm going to skip questions for now, and we are running out of time, and offer the audience and those in the future to feel free to contact you via these web pages. They all have the contact information and/or provide questions at a later date. Up to you, Maria. Thank you.
Great. Thank you, Steve. That was a really outstanding panel. And thank you, Megan, David, Gaston. We look forward to continuing to engage all of you, especially as our market continues to grow down here in the Southeast and in Georgia. So thank you, Steve, for pulling together that outstanding session. I know we've got some high fives, some thank yous from the audience right now. And I know that this will be viewed many more times over the next few weeks while it's accessible to our attendees that are joining us over the next couple of weeks. But with that, I know we need to pivot to our next session, but thank you again for all the outstanding information. We look forward to engaging everybody in person in 2022, but I wish everyone a safe and happy day, and I'll see you online for those that are staying with us at our next session. Thanks.
Thank you.
Thank you.